this helps me move to the topic I began before Sharan came in, which is we have seen the lawyer's perspective, we have the adjudicator's perspective, but the CA's perspective is very important. And the CA's perspective is because they are close to the market players, they're close to the decision makers most often. Pallavi ji, of course, you are with Grant Thornton, you're a partner there, you specialize in tax, you see litigation closely, you're a chartered accountant. What's your perspective? What do you think this product has for the market?
Prateek, for starters, it's a pleasure to be a part of this core group and happy to bring the chartered accountant's perspective to weigh in here. So you're right, we sort of see litigation very closely, whether it is as advisors, whether it is as auditors, because you're always trying to, even when you wear an auditor's hat, you're trying to see whether you need to make a provision for a litigation, or is it something that's completely contingent and only requires a mention in the financials. And, while I've seen that pain as an advisor, I must add that till about a year ago, I was the head of tax of a large company where I've actually run an international arbitration under the BIT, India-UK BIT, Bilateral Investment Treaty. So I've felt the pain of a litigant as well. So, clearly there is a case to be made for third-party funding. There's several reasons, which we've seen with people and I've experienced is, one is the ability to create a level playing field. I think Sharan made a mention about it when he said that, sometimes there can be a huge disparity between two litigants. And you'll invariably find that the party that has deep pockets invariably has access to better resources, better counsels. So I think getting third-party funding would also be a great leveler. The second benefit that I see is, the ability to bring more objectivity. And I think that's, again, something that was mentioned earlier that, sometimes people's egos come into play and, people lose their sense of objectivity. I think the moment you bring in a third-party funder, there is someone who's taking an outside-in view of the litigation. And I think that hugely helps in making sure that you have better representation, you have better management of your risk. And third, of course, is, at the end of the day, we are accountants. So anything that doesn't hit your bottom line, doesn't affect your EBITDA, is always music to your ears. So, there are some very compelling reasons why I think people will look at third-party funding. Prateek, you're on mute.
You did say that you have seen the painful side, the litigant side in a BIT, which we all know how expensive, especially the ones involving you were involved in, how expensive they got eventually. What do you think would be your perspective as a general counsel at that time if you were to use litigation finance, or as a matter of fact, any other corporate when they had to use litigation finance? What do you think? Why would it appeal to them?
For starters, I think that was the only time in my career when I regretted not being a lawyer. I never knew what, experts can cost you and what international lawyers can cost you.
Montek, that's for you.
I think that's for all the international lawyers and experts on this panel. But, really, if you look at it from a corporate's perspective, it's just such a long drawn battle that if, one could find a way to fund it, I would have definitely explored that possibility when I was in those shoes. And the reason, as I said, was, I remember being told by my CFO that, this is turning out to be a bottomless pit. I still remember, Sindhu mentioned about budget and, we had a budget before we started that international arbitration. At no point in time can you go and tell a lawyer you've exceeded the budget. We had a QC on the litigation. How do you go and tell a QC our budget is getting, sort of extended beyond what we'd anticipated? So really, it's litigation I've now realized, especially of the, the gamut that you get into when you get into an international arbitration, it's really like surrendering yourself, you can have some guardrails to say, what you will do, what you won't do, but really it's very difficult to pull back after a certain point in time. So, if you have somebody who can, bring in certain resources, it definitely helps because it's significant amount of costs that are involved.
But do you think wouldn't be easier to just go get a loan from the bank instead of getting this complicated litigation finance, going through assessment, etc.? I'm sure, big corporates have such large abilities to raise debt. they could raise, some money and just finance it for their. Why look at litigation finance?
So Pratik, nobody really funds you for litigation in the traditional, sense. Even when you do, it's a working capital loan. You have to justify. It's a function of, what you need to, the gap between your debtors and your purchases. Then you have internal accruals, and that's probably the most expensive way to fund anything. And corporates always have these pulls and pressures. I mean, business has to take its own course. There's capex lined up. There are expansion plans that need to be executed. So it's very difficult. I mean, when you run a high value litigation, it actually takes a toll on the business. And as I said, no bank ever funds you for litigation. So if anything you pull out of your working capital or out of your internal accruals, you're either affecting the dividends that you give out or you're affecting the expansion of the company. So really, when you get a third party funding in, you're actually ring fencing all of that by saying, okay, we run with this financing, and for the rest, it's business as usual. So it's definitely worth evaluating.
It's a very useful perspective, and I hope all the general counsels on this call are listening to this insight. And it's finally their chance to monetize their department, which is looked as the cost-sucking department usually, to make it into a department which is actually generating revenue without cost. But all this discussion at the end boils down to one, right? What's the number? How much money I'm going to get from the litigation, how much I'm going to win, right? No one asks me what law is right or wrong. No one cares about that advice, right? What you care about is what's the money at the end of the day. And for that, we have Mr. Mayal with us. He needs no introduction in Indian or any market. He's known and touted to be one of the best quantum experts in the field. Montek, what's your role in preparing a case for a funding?
First of all, thank you not only for inviting me to this panel and the working group, but for the very, very kind introduction. I think I had a smile whenever from the beginning of today's conversation, someone mentioned quantum, value, amount, compensation, because all those questions are ultimately become a question that people like us are asked to answer. And I think one of the advantages of going last is all the build-up is already done for you, and most of the key points are already been made. So you can leverage that and go straight to the point. I have a short answer and a slightly longer answer. The short answer is the role we play is essentially the same whether we are used in the process of raising financing or the larger role we play in the disputes proceedings as expert witnesses, which is to identify, analyze, and quantify the economic loss suffered by the injured party on account of the alleged breaches or wrongful acts of the other party. Why is that important? Because that informs the monetary relief, the compensation or damages that the injured party is going to seek in the legal proceedings. Now, that's the role. Right now, turning to the larger, perhaps less articulate answer and how that role sits in the process of raising financing. We've discussed how third-party financing is essentially a form of non-recourse funding, where the third-party funder essentially bears some or all the costs of running the case. And in exchange for that, it takes a share of the results of the case, right? If the case, of course, is successful. So clearly, for any form of financing, right, due diligence is absolutely key. And the funder will want to be satisfied before it makes that financing decision with the legal, the factual, and the economic considerations and risk of the case, right? And in the economic considerations, a very important part, as Pratik, you also mentioned, is essentially the number. So you need to understand, you want to be clear about the quantification of the economic losses or damages, which will inform the value of the claims being pursued, and therefore any returns that the litigant and the funder might reasonably anticipate. And this is where clearly the funder and the client or the counsel require certain help. And this can be tricky and good for people like us. Sometimes the calculation of losses is not straightforward. And in that case where a damages expert or a quantum expert can be quite relevant and important to the overall process. So experts can help you identify and substantiate your claims independently and objectively. And in doing so, they often also offer economic, financial, or technical evidence and analysis that otherwise is not available to the parties or eventually to the tribunal or the court. And I think such evidence and analysis is often quite critical in the context of establishing and assessing damages. And I think this is where I think the role is quite important. When a funder is looking at the question of damages, and that's obviously important because that not only informs some points which were raised earlier about the budget, because the ratio of budget to claim they want to maintain, and of course they are very much interested in the final award that might be reasonably anticipated. Experts can help you quantify those damages in an independent, objective manner, which then therefore informs not only the funding process itself, it also perhaps informs the funding arrangements and the terms of such arrangements which are agreed between the parties at the outset. I think that's where it's critical. It gives you an independent assessment. You get more comfort from the use of experts on the figures being claimed. Often that forms part of the early case assessment that the funder and the counsel undertake. And usually that's supported by a memo or a preliminary analysis by people like us, which again gives them more comfort in the final decision the funder will make. So I think that's where our role fits in, essentially to establish and calculate those damages which can be reasonably anticipated and ensure the claims which are you bringing forward are not unsupported, are not unjustifiable, and are definitely not inflated before any funding arrangement can be concluded.
I think those are very good points you make, and it actually ties in with what the Privy Council or the Indian courts require you to do before funding, right? Ram Kunur Kundu, as I said, the court says you need to get the commercial value of the claim right on day one before investing, right? That's the test of a valid agreement under Indian law. A fair agreement is one which the commercial value can be assessed prior to the result. How do you do it? How do you reach a commercial value of something which is so unreliable?
You asked me to answer a question that I often take a couple of months to answer on every case. So it's unfortunately not a straightforward matter. But let me try to see what I can summarize in a minute or two. So look, I think at the outset of any case, right, the value you ascribe to a claim is clearly a function of multiple factors, right? There are legal ones, so chances of success on merits, establishing liability, and how long it might take, the process itself. There are economic ones, which I was described earlier in my previous answer, which is the economic value of the claim itself, obviously assuming the liability is established. And the third one are commercial ones, because chances and timeline of successful enforcement and the final recovery is also a question a funder or a injured party will take into account, because what's the award worth unless you can get the money back, right? So clearly many factors will affect one's assessment of the claim, particularly at the outset of an arbitration or legal proceedings, because many of those factors as I described are unknown or can have multiple, can evolve in multiple ways. And it's therefore very, very important, and I think sometimes this is missed, is the experts to work closely with counsel and the legal team to conclude on the value of the claims at the outset. But just sticking to the economic considerations, because which is what falls perhaps within our role and our expertise. Look, there are a couple of quick points I'll make on this. First, obviously, the calculation of damages must be consistent with your legal and factual position. You'd be surprised how often the two don't marry with each other well. And that's a concern, because clearly a quantification of damages on a different legal principle than pleaded will be set aside quite quickly. And I know Prateek has experience with that quite often in his arbitrations. The second obviously is an understanding which principles to apply under that legal framework. And that's very, very important. So of course, the two forms of damages you might have come across, the two frameworks of damages which are quite prevalent in understanding what you might claim, is what we call an expectation loss in our framework, which is understanding the profits, the lower profits you have now earned because of the breach. It's also called a lost profits approach. The other principle is a reliance loss measure, which is essentially the cost you've incurred under the contract, which you might claim. So again, the very different legal principles, and they inform different economic analysis you'll undertake to answer those questions under those frameworks. So it's very, very important to get that right. And that, of course, sits exactly with what you were saying, which is the claim must be of fair value, must be reasonably priced, and that must be based on the framework you're applying. The second point, so that's the first one, the framework and the legal principles and the economic approach you undertake based on those principles. The second, again, something I know many of us on this panel have a very different views on this, is assessment date. Damages are assessed as at a date, and therefore you must acknowledge and agree on that, because that will inform the value of the claim as at that date. So it's critical for any damages calculations to be consistent with the date you're assuming in your assessment, right? And therefore the claim must be assessed as at that date. And why is that important? Because the date then if therefore informs the information the valuer or the expert might take into account in analyzing the claim. And third, finally, which is I think where we add perhaps the most value, is the actual calculation itself. Now, when you're calculating a fair market value, if it's an investment arbitration, if you're calculating a lost profits under a breach of contract case, you must make reasonable assumptions and undertake and implement an approach which can be substantiated through evidence, whether technical, economic, financial evidence, or market evidence. Your assumption must be benchmarked against available information around the industry you're working in or the company you're working for. So these are critical assumptions which obviously inform any valuation, right? So if you, as a simple example, if the damage is related to a coal mining asset in South America, you need to understand the value of the coal mine which has been affected. And as many people on this call will know, that's a complex question. It depends on how much you can dig out. It's at what price you can sell it at. It depends on the cost you'll incur in setting up the mine or in producing the mine coal. So it's a difficult question. It often sort of involves multiple disciplines and multiple analyses to sort of answer that question. And it must be in the end based on reasonable assumptions and projections, right? So it's a combination of those three, right? Get the framework right? What's the legal position? Get the date of assessment correct. And that's quite important. There have been judgments where entire claims have been put aside because the date was wrong. And third, under those principles, get the approach and assumptions right, get the economic evidence right. And I think the combination of those three will hopefully answer the question for which I'll normally take 3 months to answer, but I've done my best to answer it in the last 3 minutes.
Thank you, everyone.